Imagine this. Your younger cousin fresh out of college excitedly shows you a Bitcoin chart on their phone talking about buying the dip. Meanwhile, you, a millennial, can't help but remember hearing about this internet money back in 2010, maybe even considered buying a few coins, and didn't. Sound familiar? Cryptocurrency, a term that evokes images of meteoric gains, dizzying crashes, and a future where money is truly digital. Was this craze just a flash in the pan, or is it fundamentally reshaping the financial landscape, especially for Gen Z? Welcome to Crypto Craze. Is Gen Z investing or skeptical? At its heart, crypto promises decentralization, bypassing traditional banks, and a chance for unprecedented financial returns. It's digital scarcity verifiable on a public ledger, but it's also volatility, complexity, and risk. Did you know that while ownership rates between the generations are getting closer, with one 2025 study showing 52% of millennials and 48% of Gen Z have owned crypto, their approaches couldn't be more different. This isn't just about money, it's about a fundamental difference in how generations perceive risk, trust, and opportunity in the digital age. If you've ever dipped your toes into crypto, hit like. If you're still watching from the sidelines, definitely subscribe. We're breaking down the generational divide in the digital gold rush. Digital natives versus legacy holders. The entry point to crypto. To understand this divide, we have to start at the beginning. How do these two generations even enter the world of crypto? The answer lies in their fundamentally different experiences with the digital world. For Gen Z, it's intuitive. For millennials, it's often a calculated decision. For Gen Z, born and raised in a fully digital world, crypto isn't a foreign asset class to be cautiously studied. It's a native extension of their online lives. Downloading an app like Coinbase is as frictionless as signing up for TikTok. This digital fluency, combined with an inherited skepticism of traditional financial systems that they feel failed previous generations, creates a cohort primed to bypass the old guard. They aren't just investing. They are participating in a digital culture starting at an average age of just 19. Millennials, in contrast, approach crypto carrying the memory of past economic traumas. They witnessed the dot-com bust and, more importantly, came of age in the shadow of the 2008 financial crisis. That experience instilled a deep-seated caution, a prioritization of stability, and a skepticism of any asset promising easy wealth. Their financial education, if any, was rooted in stocks, bonds, and retirement plans, the tools of an analog world. For them, crypto isn't a natural next step, but a deliberate diversion from the known. The data confirms this divergence at the entry point. While millennials may have higher current ownership rates due to more years of capital accumulation, it's Gen Z that shows greater relative conviction. A 2024 World Economic Forum report found that a staggering 35% of Gen Z investors allocate over half of their portfolio to digital assets. For them, crypto isn't an alternative asset, it's a foundational one. Consider the narrative around NFTs. A Gen Z user might proudly display their NFT profile picture as a badge of digital identity and community belonging. A millennial looking at the same image is more likely to ask the pragmatic question, but what does it do? This contrast isn't just about technology. It's a fundamental shift in what constitutes value, from tangible utility to cultural significance. This is for illustrative purposes only, and not financial advice. This divide has profound implications. For Gen Z, crypto is a new form of digital gold, a native asset for a digital native world. For many millennials, it remains a speculative asset to be approached with caution, added to a portfolio built on traditional principles. This difference doesn't just shape how they invest today, but how they will build wealth tomorrow. Risk and reward to the moon versus been there, done that. The difference in their entry points leads to an even wider chasm: their perception of risk and reward. For Gen Z, the mantra is often YOLO. You only live once, fueled by a belief in disruption and a sense that traditional paths to wealth are too slow or inaccessible. For millennials, experience often whispers a more cautionary tale: been there, done that. Gen Z's to the moon mentality is fueled by a digital environment where investment trends can go viral, like a TikTok dance. They've grown up seeing tech startups achieve billion-dollar valuations overnight, and they believe that same disruptive potential exists in finance. For many, the traditional path, college, a stable job, retirement savings, seems fraught with debt and uncertainty. Therefore, crypto's volatility isn't a bug, it's a feature. It's a risk worth taking for a chance to get ahead. Millennial caution, on the other hand, is forged in economic fire. They saw their parents lose retirement savings in 2008, and many have struggled with wage stagnation and student debt themselves. These experiences created a preference for stability. They are more likely to have financial responsibilities like mortgages and families, making speculative gambles less appealing. Their skepticism isn't technophobia. It's a rational response to a decade of economic precarity. They've seen bubbles burst before and are wary of the next one. Data on risk tolerance highlights this divide. While a Gallup poll shows millennials' perception of Bitcoin's risk has softened over time, a 2024 Bank of America study found that wealthy younger investors allocate 14% of their portfolios to crypto, a figure 14 times higher than the 1% allocated by investors over 44. This points to a fundamental difference in strategy. Millennials may be diversifying, while a significant portion of Gen Z is making a concentrated bet. To illustrate this contrast, consider two real-world narratives. On one side, you have the to-the-moon dream epitomized by Eric Feynman, who famously turned a $1,000 gift from his grandmother into a multi-million-dollar fortune by investing in Bitcoin at age 12. His story became crypto gospel. On the other side is the rug pull nightmare. Look no further than the collapse of the Terra Luna ecosystem in May 2022, which wiped out over $40 billion in investor value. The story of a 19-year-old who saw his $400,000 net worth vanish overnight, leaving him stuck at home depressed every day, is a chilling reminder of the real risks involved. These opposing narratives are at the heart of the generational divide. Gen Z, driven by FOMO, fear of missing out, sees the potential in volatility. Millennials, shaped by memories of collapse, see the peril. This isn't just about risk tolerance, it's about the lessons each generation learned from their unique economic history, shaping how they navigate the financial future. We've seen the highs and lows. Which generation's approach to crypto resonates most with you? Or have you experienced your own crypto triumphs or cautionary tales? Drop a for gains or a for losses in the comments and let us know your story. Community and information TikTok trends versus financial news. The difference in risk appetite is amplified by another crucial factor where each generation gets its information. Gen Z's information ecosystem is decentralized, social, and fast. The millennial ecosystem tends to be more centralized, vetted, and methodical. This divide shapes everything from the coins they buy to the trust they place in the market. Gen Z lives in a world where financial advice is democratized, but also algorithmically driven. Platforms like TikTok, with its FinTalk Corner, YouTube, and Discord servers, are their primary sources.
Wow.
A 2023 study even found that 64% of Gen Z prefer seeking financial advice from YouTubers or social media influencers over traditional financial advisors. In these communities, information, or alpha, is shared rapidly. An influencer can promote a new coin, and thousands might invest within hours. Millennials, while also online, are more likely to adopt a hybrid approach. They rely more heavily on internet searches, financial companies, and professional advisors. They might see a trend on social media, but then cross-reference it with long-form articles from established financial news outlets, or even dive into a project's white paper. Having grown up with a pre-algorithmic internet, many retain a more active search behavior, seeking out multiple sources rather than passively consuming a curated feed. Data on trusted information sources makes this clear. A CFA Institute study shows Gen Z relies more on social media and family, while Millennials and Gen X lean more on financial companies and professionals. This creates two very different feedback loops. Gen Z gets caught in rapid hype cycles where social proof and influencer endorsements can send an asset soaring. Millennials are more likely to be swayed by sober market analysis and regulatory warnings. Imagine this scenario: a Gen Z investor gets an alpha call in a Discord server about an upcoming meme coin. They act fast, invest a small amount, and see it double in a day. At the same time, a millennial investor is reading a 5,000-word analysis on the regulatory risks facing a major stablecoin. They decide to wait for more data before investing. Both approaches have merit, but they lead to vastly different outcomes. This is for illustrative purposes only and not financial advice. This information divide is a double-edged sword. On one hand, it has democratized financial education, making it more accessible than ever. On the other, it has created a breeding ground for misinformation, scams, and echo chambers. A study by Credit Karma found that while many young people have improved their finances from social media advice, a quarter of Gen Z also reported being scammed. The future of investing is being shaped not just by technology, but by the information ecosystems we choose to trust. Beyond investment, crypto's cultural footprint and future. Finally, the generational crypto divide extends beyond mere investment. It touches the core of how each generation forms identity, builds community, and envisions the future of technology. For Gen Z, crypto's primary impact is cultural. For Millennials, the deeper interest often lies in its technological promise to fix the systems they inherited. Gen Z is actively weaving crypto and blockchain into their cultural fabric. NFTs are more than assets. They are digital status symbols, tickets to exclusive online tribes. Web3 games with play-to-earn models are turning entertainment into an economic activity. They are the native pioneers of decentralized finance or DeFi, experimenting with lending and yield farming protocols without a bank in sight. For them, blockchain isn't just a ledger, it's a playground to social network and a platform for self-expression. Millennials, by contrast, often direct their interest toward the infrastructure layer. Their focus is frequently on the practical enterprise-level applications of blockchain technology. Shaped by their distrust of opaque institutions, they see blockchain's potential as a tool for solving real-world problems. They're interested in how it can create transparent supply chains to ensure ethical sourcing, or how it can create immutable accounting ledgers to prevent corporate fraud. This is a problem-solving orientation that seeks to leverage the technology to reform the existing world. This pragmatic mindset also makes Millennials a more receptive audience for central bank digital currencies, or CBDCs. A CBDC, a regulated state-issued digital currency, represents a compromise that is highly attractive to this cohort. It offers the efficiency of a digital currency with the security and stability of a traditional financial institution, mitigating the Wild West risks of purely decentralized crypto. Data on the adoption of these technologies is still emerging, but early trends show Gen Z leading the charge in the personal and social use of NFTs and DeFi, while institutional interest, often driven by millennial-aged professionals, focuses on integrating blockchain into existing financial infrastructure. An illustrative anecdote: a Gen Z influencer might launch their brand using NFTs for authentication and community building, while a millennial consultant explains the underlying tech of a CBDC to a major bank. This reveals two parallel tracks for the future. One, led by Gen Z, is consumer-facing, highly cultural, and shaping the future of digital identity. The other, driven by millennial pragmatism, is enterprise-focused, transforming industries with demands for security and efficiency. The future of finance may not be one or the other, but a complex synthesis of both. Conclusion and recap. So, where does this leave us in the crypto craze? Clearly at a generational crossroads. Gen Z, the digital pioneers, are charging into the decentralized frontier, driven by a mix of tech fluency, skepticism of old systems, and a desire to build something new. Millennials, the cautious observers, are engaging more methodically, shaped by the scars of past crises, but drawn to the promise of a more efficient and transparent financial system. While the craze phase of crypto may have mellowed its underlying technology, and the psychological shifts it instigated are fundamentally changing how younger generations perceive and interact with money. Crypto may no longer be the omnipresent, hot trend it once was, but it has undeniably reshaped how an entire generation thinks about investment risk and the very concept of money. The future of finance for Gen Z is being written right now. One volatile trade, one digital wallet, one meme at a time. Their experiences today will define the financial landscape of 2030 and beyond. Have you ever invested in crypto? What do you predict for its future? Tell us below. And hit like, subscribe, and tag a friend who's either to the moon or utterly bewildered by crypto. Follow GenShift for more deep dives into the future of money and generations.